In this video, we're diving into a unique trading indicator known as the FVG channel. This tool brings together two key price action concepts, fair value gaps, which is in the name, and Fibonacci ratios to create dynamic, effective trading bands. By combining these two concepts, the FVG channel is a clear upgrade over similar indicators like Bollinger Bands. In this video, we're going to explore what makes this indicator so powerful and how you can use it in your trading strategy. Let's get started. To begin with this indicator, head over to TradingView, the platform I'm using today. If you need to sign up, there's a link in the description to get you set up. Once you're on TradingView, click on Indicators and search for FVG channel, making sure you select the one by Lux Algo. And here it is, the mighty FVG channel indicator. You might be thinking, okay, what is it exactly? Well, it's a technical analysis tool that helps visualize trends and potential market reversals by using historical fair value gaps. It does this by drawing a channel based on the averages of recent unmitigated FVGs, giving traders a structured way to interpret price movements. For those who aren't familiar, an FVG, fair value gap, is created when there's an imbalance between buyers and sellers, often showing up as an unfilled gap between candlesticks. This is a bullish FVG and this is a bearish FVG. These gaps are used to create the outer bands of the indicator. Basically, to make the upper extreme band, the indicator averages recent unmitigated bullish FVGs within the selected look-back period. And for the lower extreme band, it averages recent unmitigated bearish FVGs. Now, what about this green dotted line at the top? This is called the upper inner band. It's based on the Fibonacci number 0.78, which you can find using the Fibonacci tool. Here's how it works. If you take the Fibonacci retracement tool and click on the upper extreme band, then drag it down to the lower extreme band, you'll see that the upper inner band aligns exactly with the 0.78 Fibonacci retracement level. On the flip side, the lower inner band is set at the 0.23 Fibonacci retracement level. So by trading with this indicator and using the retracement levels marked by the dotted lines, you're actually trading based on Fibonacci, which is super helpful and something you won't find with indicators like the Ichimoku cloud or moving averages. The central line, known as the midpoint, sits at the 0.5 Fibonacci retracement level, acting as the key axis point for the indicator's analysis. This is exactly what makes this indicator so unique. Not only do you get the upper and lower extreme bands based on recent fair value gaps, a vital price action concept, but you also get three inner bands based on Fibonacci retracement levels. Looking at the indicator settings, you can adjust the look-back period for unmitigated FVGs. An unmitigated FVG is one that hasn't been revisited by the price. For instance, this is a bullish FVG where the price just goes up without touching it again. How many candles back do you want the indicator to consider for the calculation? Personally, I set it to 10. The smoothing length controls how much smoothing is applied to the channel. Higher values reduce noise, but they can also delay how quickly the indicator reacts to price changes. I'll stick with a default of 9. Here you can choose the fill type, whether it's gradient, single color, or no fill. You can also adjust the colors for the upper and lower extremities, the average, and these options. Style tab gives you various visual options to toggle on or off. You can change anything you like, but for now, there's one big question I need to answer. What are these horizontal levels? Well, these red and green horizontal levels are called breakout levels. When the price has mitigated all FVGs in one direction, except for one, the indicator will display a breakout level. This is the level the price needs to break to fully mitigate all FVGs in that direction. These levels can act as potential support or resistance. But don't forget to watch for breakouts. If the price moves strongly above or below these levels, it shows strong momentum. So when the price clears all the FVGs to the upside but leaves one unmitigated, the indicator will print a red breakout level as a resistance. Conversely, if all the FVGs are cleared to the downside, a green breakout level will appear as a support. Next, we have the up and down arrows, which represent bullish and bearish signals. These appear when all FVGs in one direction have been mitigated and an engulfing candle is printed afterward. For example, if you have a series of bullish FVGs but the price drops, mitigating all of them, and a bullish engulfing candle appears afterward, the indicator will print a bullish signal. The opposite happens for bearish signals. These can act as buy and sell signals, but of course, you should combine them with other factors like support and resistance to improve your trades. So how can you use this indicator in your trading? Well, just like with Bollinger Bands, one of the first things you'll do is identify the trend. This is a bullish trend and this is a bearish trend. You might be wondering, how do I know it's a bullish trend? Well, a bullish trend is when the price stays consistently above the midpoint. But to consider it strong enough for a trade, you'll want the price to stay above the upper inner band. For a bearish trend, the price needs to stay below the midpoint, and for a solid bearish trend, it should be consistently below the lower inner band. This is just one way to use this indicator for trend identification, but there are other strategies. Remember the buy and sell signals? Let me show you a trading strategy that uses these signals. For example, if you see a red downward arrow, a sell signal, instead of taking the trade immediately after the engulfing candle, you'll use the rectangle tool to draw from the closing price of the engulfing candle to the high of the highest candle in the swing. Then you want to find a previous resistance level that was retested by the price. The idea is to have a double top structure with two resistance levels. So you've got one resistance level, the price tests it again, and then a sell signal appears. If these conditions line up, you can enter a short position with a stop loss just above the resistance level, aiming for 1 to 1.5 times the risk. Let the trade run, and it should be profitable. Of course, you can reverse the setup for a long position. Another feature of this indicator is the breakout levels, these red and green horizontal levels. To use these for trading, look for the price to break and close beyond these levels. For a long position, make sure the market trend is bullish, with the price above the midpoint and as close to the upper band as possible. Then, when an upper breakout level appears, look for the price to break and close above it with a strong candle. If the breakout is weak, like with a tiny candle, don't take the trade. When you see a strong breakout, you can go long with a stop loss just below the most recent swing low and a take profit of 1.5 times the risk. If the trade works out, it should be profitable. Now, even though we've covered two trading methods, my favorite way to trade with this indicator is by focusing on pullbacks in bullish and bearish trends. Here's how it works. For a long position, you want to first make sure the market is in a bullish trend, indicated by the price consistently above the midpoint. But for this strategy, you want it to be a strong trend, so it should be trading mostly above the upper inner band. Once that's in place, wait for the price to pull back and touch the dotted line with a wick, like here. Then look for a green candle to signal your entry. This is your pullback. Next, you need to check for a gap before the pullback. The gap should be at least 15 candles. You can measure this with the price and date range tool, drawing it from the pullback candle all the way back to the last time the price touched the dotted line. If the gap meets the minimum of 15 candles, you've passed that condition. Also, check the trend. If it's strong enough, you'll want at least 30 candles since the price last touched the midpoint. Once all the conditions are met, you can enter a long trade, setting your stop loss at the midpoint and using a 1.5 to 1 risk-reward ratio. If everything lines up, it should be a profitable trade. Of course, you can do the reverse for short positions. In this example, the trend was bearish with the price consistently under the midpoint, and after a pullback, a red candle touched the dotted line with a wick. The gap check meets the 15 candle requirement, and the trend check gives us more than 30 bars. With all these conditions met, you can take a short trade with a stop loss at the midpoint, targeting a risk-reward ratio of 1 to 1.5. This setup should also be profitable. That's it for today's breakdown of the FBG channel indicator. I hope you found this guide helpful and that you can start applying it to your trades. If you liked the video, don't forget to hit the like button, subscribe, and ring the bell for more trading tips. Drop any questions or thoughts in the comments below. I'd love to hear from you. Thanks for watching, and I'll see you in the next one.